Okay, that's the view coming in on individual names, but let's bring on board Chakri Lokapriya, CIO and MD at TCG AMC. Chakri, great having you with us. Good afternoon. And I'm going to start off by talking about this new fund. That's the Primario Fund, aiming to raise about 1,500 to 2,000 crore rupees. Can you just give us a little bit of flavor as to the kind of companies that you're looking to invest in and what is the overall investment objective of this new fund?
Hello, good afternoon. In fact, the whole premise is based on the fact that over the last 5 odd years, corporate Indian earnings has slowed down. If you look at Nifty's earnings, CAGR has been only about 5 or 6%. And even the stock market returns has been only about 5 or 6% CAGR. Of course, this year alone has been a fairly strong year. Now, corporate earnings slowing down has translated into lower profits and weaker balance sheets for companies, because in a country where you have 4 or 5% inflation, which means companies haven't grown. So against this backdrop, we think there is a need, and we see a huge need for institutional capital across sectors, which if infused into companies will help them to launch new offerings, expand their markets, deleverage balance sheets, and therefore translating into higher stock market returns.
Okay. So, what really would be some of the preferred sectors of this fund?
It's a diversified fund because, across sectors, whether it's chemicals, petrochemicals, industrials, or even banks, there is a huge need for capital. Now, if you look at the bank recapitalization program announced by the government last month and the subsequent Moody's upgrade, both has provided a catalyst for companies to go out to strengthen their balance sheets and in the form of raising capital in the form of institutional placements. So we are seeing opportunities across various export sectors like textiles, chemicals, domestic sectors such as infra, and of course banks and other aspects in the financial services.
Okay, and Chakri, let's come to your overall view on the markets at this juncture. Do you believe that the kind of liquidity that we are seeing, particularly from domestic institutions, is likely to continue and keep the market afloat? Does the trend for the market look strong?
Given that what our outlook is, which is the reason why we are launching this fund, is on the backdrop of very weak earnings over the last 5 odd years, which has not really translated into higher stock market returns. Only this year has been a fairly strong one. So against this backdrop, which simply means that Nifty is not overheated, earnings revival has not yet happened, and with this infusion of capital, which you will see number of companies lining up, you will see what acceleration of earnings in going into maybe FY20. Because companies need to prepare themselves. So against this backdrop, we think the market is going much higher from current levels.
What's the outlook when it comes to the overall financial sector? I understand that for this new fund as well, there will be a thrust, as you said, on banking and financial. But how have you looked at the overall recent news with respect to recapitalization, how that changes the face of things for some of the PSU banks, and what have you made of the corporate earnings that we've seen in the quarter gone by?
Two things. One, in the quarter gone by, you've seen that the corporates are beginning to revive. You have a top line growth of roughly about 8 to 10%. And in the case of earnings, the number is slightly higher, maybe about 12 odd percent. Mind you, this, if you rewind back sufficiently in time, about 2007-8, earnings growth of the Nifty was 35%. ROE was 28-29%, whereas today ROE is only about 12%. So the bank recapitalization is a catalyst, because now it allows banks to take provisions, move forward, make fresh loans to various corporates, and therefore corporates also start growing.
The whole export-related sectors, Chakri, why does this catch the fancy of your fund? And can you just talk to us about how the overall currency movement would impact some of these sectors, some of these stocks, and what really is it that stands out?
It's a good question, because if you look at various export-related sectors, let's take textiles as an example. You have a number of companies who have already expanded capacities, currently sitting on about 40-50% capacity utilization, companies such as Trident. And they are looking now, they have some amount of high-cost debt. They're looking to swap it to lower their overall cost of debt, and therefore will lead to an acceleration of earnings. And meanwhile, export markets, the end markets, US is extremely strong, Europe is very strong, except the UK, and that trend of economic revival in developed markets is going to continue for the next couple of years. On the other hand, you have chemicals. Chemicals, again, partly is also the same story, which is strong export markets, plus China, because of pollution controls and badly run companies, they shut down and therefore lower supply, which leads to better pricing for Indian chemical companies. And Indian chemical companies have been smart enough with the management in setting right their balance sheets and are going out there seeking capital, and therefore the end markets are looking strong. Valuations are not expensive. Companies such as Aarti Industries or Make Money Organics. And like that, you have several sectors, including some pockets of pharma, where the troubles are behind them. They will now look to grow.
Still seeing potential in some of these chemical names as well as individual pharma stocks. Chakri, lovely having you with us on the show. Thanks so much for joining in, and Manas as well for sharing with us your technical expertise. On that note, we'll slip